We're going to try and reconnect to Mr. Sunil Ranade, the CFO at Mahanagar Gas. Mr. Ranade, good morning. Good to have you on the show. Wanted to figure out how your operations were this quarter in terms of scale of business and whether they're back to pre-COVID levels.
Good morning to all of you. Yes, we are happy to announce that we are fast bouncing back. There are some customer categories where in fact we are doing better than pre-COVID level. For example, in case of household customer category, the sales volumes are even higher than the pre-COVID levels. Similarly, in case of industrial customer category, sales are much higher than the pre-COVID levels. However, in case of our flagship customer segment, which is CNG, we are still operating somewhere around 95%. I think over a period of 1 month or so, we should be back to our pre-COVID level. So on operations level, I think we are fast improving. I think within 1 month or so, we should be back to our normal position.
Right. What were the factors leading to the sharp expansion in your operating margins and whether or not the margins look sustainable from here onwards?
These margins are dependent upon multiple factors actually. One of the important in case of industrial and commercial will be the prices of RLNG spot gas which we buy for industrial and commercial category. That's an important factor. Another important factor will be the oil price levels on which our sales realizations of this customer category are dependent. Equally important will be rupee dollar exchange rate. Most of the gas which we buy is in dollar denominated terms, whereas possibly you must be aware our sales is in rupee terms. So that is also an important factor for us. So margins are definitely dependent on these factors apart from our OPEX and other expenditure which we incur. This particular month we have seen, or this particular quarter ending December, we have seen there was expansion in the margins. Multiple factors have helped. One of the important factors is the net sales realization in industrial and customer category was pretty impressive. Also, as the volumes have gone up as compared to Q2, the per unit cost of OPEX has come down, and that has helped us to improve the margin. I think as long as the oil price levels continue at the present level, and since the spot gas prices of RLNG gas has reasonably stabilized, we feel the margins will be steady, or maybe a bit of improvement also we can see in industrial commercial category. Whereas in case of in CNG and domestic, we are pretty hopeful of maintaining the margin. There could be a possibility of gas costs rising in these customer categories. However, the ability to pass through the gas cost is pretty good with us, and with that ability taken into consideration, we hope the margins could be sustainable in the medium term.
Okay, how are net realizations, and what's the outlook on realizations as well from here on? The way gas prices have moved, what can we expect?
Can you repeat the question, please?
Okay, I wanted to talk about, in terms of realizations as well, and the way prices have moved up, what can you expect on that front? And on volumes, what kind of levels you're looking at over the next few quarters? We've seen some recovery Q on Q, but what about momentum going forward?
Yeah, particularly industrial and commercial prices, the way we follow the philosophy of sales price in this customer category, it is linked or benchmarked to alternate fuel prices. So depending upon that, the net realizations will change. However, also important factor to consider will be the gas cost. Now, generally the oil prices and gas movement, particularly gas price movements, move in tandem. So assuming even if the net realizations come down, but there are chances that there could be drop in imported gas purchase price, and that will still help us to maintain the margins. Apart from that, we have done another couple of another strategic moves we have undertaken. For example, so far the dependence on the spot gas was very high, whereas now we are also tied up with Reliance Gas, which is a domestically produced gas, which is now also available at attractive price, particularly for industrial and commercial customer category. We'll be also looking for some mid-term sourcing of gas that will be definitely able to help us to maintain the margin in industrial and commercial category. And in case of domestic and CNG, we don't see any problem because the alternate fuels are petrol and diesel. The discount which we are offering right now vis-a-vis petrol and diesel for our customers, I think we expect that volume will also improve, and at the same time we should be able to maintain the margins as well.
Okay, so that's on pricing and volumes as well at this point. In terms of capex, the Raigad region, how much are you sending there? How much will your overall capacity go up by as well? We do understand you're trying to expand your footprint, so how much will go into that region, and what else are you planning on that front?
Yeah, there are aggressive capex planning we are considering. We expect the capex plan to almost double as compared to current financial year in the next financial year. We will be definitely expanding into our new geographical area, which is Raigad district. There will be substantial expansion seen in the Raigad district. There is a new city gas station or terminal coming up in the Raigad district. We will continue to expand our domestic customer network as well as CNG outlets. We are expecting to increase manyfold, and there are expectations that even in the current operating areas, the expansions will continue.
Okay, Mr. Ranade, on the PNG and CNG side, what's the utilization looking like? What's the kind of volume growth possible, especially since the industrial sector is gradually getting back on track?
CNG utilization, if we are talking about infrastructure utilization point of view, then today at nearly at 50% capacity we are operating when we talk about capacity of compressors or dispensers. So there is enough capacity available for utilization point of view. However, if we are talking utilization in terms of volumes, say compared to pre-COVID level, I think earlier I already mentioned that we are slightly down in volume terms capacity utilization, particularly in the CNG sector, but it is fast improving, and within a couple of months, as the lockdown eases out further, we are sure we will be back to pre-COVID level.
All right. Thanks for joining us then this morning. Great speaking with you, Mr. Ranade, and getting a sense of where things stand.